Right, it's 6:30 Eastern, Sunday, the 26th of July. Welcome to another Unmissable Sunday show. Hello, Benny.
Good evening, or good morning, I should say, since it is a proper Sunday
Yeah,
show this week, where it's our Sunday, your Monday.
I continue to live the lie and pretend it's Sunday, 14 hours too late. Anyway, listen, we've got a big week coming up. I think really what we're going to do with this show is really just do a macro rundown. We've got a Fed meeting this week. We've got all sorts of things going on with the Four Horsemen of Risk. Just before we do that, on Thursday we are going to do a live show. Ask us anything. So that will be at 6:30 p.m. Eastern on Thursday evening. Do join us. There's going to be a lot to catch up on. And also, finally, a request from our social media manager, Margot. Can you please follow us on Instagram, Benny and the Squirrel, with an underscore between Benny and the Squirrel. Yeah, Benny and the Squirrel. You'll find us on Instagram. So do it. So the question for us is, are we about to have another death shot in Fedland? What do you reckon, Benny? Why don't you tell everybody what a death shot is?
So the death shot is like a concept that I came up with when you look at, when I was in grad school, I was forced to read all the long transcripts. So if you don't know, the Fed releases like basically the entire transcript of the meeting 5 years delayed, right? On a 5-year lag, and then the presentation materials. Anyway, when you go back and you look at the end of cycles, there's just these huge last minute, like, okay, let's just end this bubble right here. And I called it the death shot. But like the concept is like, all right, we've seen enough of this. We're going to make things tighter than they need to be because we've seen enough, and you can argue that the plumbing of the system is different over time. So maybe the transmission mechanism doesn't work as well as they like it to, right? As some central planner like the Wizard of Oz. But the idea is basically, June of 2000, let's rewind back there. The maestro, rest in peace.
Well, let's back up. Let's back up a bit further, right? The original death shot came out of Tokyo in 89-90, right? Where that hiking cycle really ended things finally for the Japanese bubble. Then you can come along to the more recent history. Firstly with Greenspan into Bernanke, and really it was Bernanke that fired the pistol at the end, even though Greenspan started the cycle. And then you've got a little honorary mention to the Aussies with their jumbo hike in August 08, just ahead of things completely kludging up in front of the GFC. But really, the Hall of Famer on death shots with two mentions is, of course, Jean-Claude Trichet of the ECB, right?
Yeah.
All-timer.
He's in his own league of stupidity. But let's not forget Volcker, who came in with 10.25 and 79, was at 11%, like within 2 months, and took that up to like 19 and change. And don't forget the 1929. You got to go and look at like old papers. You don't have it quite as easily as pulling it up on Bloomberg, but like there's been other death shots pre the post-80s era.
Listen, I'm capturing really what's more of the modern Fed.
Yeah.
Right?
Okay.
And listen, it's an interesting thing coming up because arguably Warsh had probably the last coolish CPI that he's going to see for a while, right? Unemployment, probably could give him some headroom, but I have a funny feeling that he doesn't want a green square against him. Now, friend of the show, Brent Donnelly, put together this table the other day. You really think that Kevin Warsh wants to have a green box alongside Arthur Burns, right? Now, ultimately,
let's also put Yellen on there. Yellen's basically the same because she should have been cut
681 days to
Yellen should have been cut in 2013, just to be fair. Like, so she deserves that green honorary
No,
box.
yeah, but okay. But the question is, I mean, my sense is that personal view. I mean, the pricing of this week's meeting is a 34% chance of a hike, or at least that's what it was on Friday.
Roughly, it's
right?
roughly whatever 33, 36, somewhere in there.
As we've discussed before, I don't think, given the way that the government, the whole of the AI data center complex, private credit, everything else, I don't think he's got too many hikes in him, right? Maybe he's got one for show to keep the bond vigilantes happy. But, you know, maybe this is his best and only window to try and you know, show some hair on his chest, right?
Yeah, I mean, if he's going to do it, he's got to do it now, right? He's got even despite, you know, oil being down 4 or 5% on the open tonight because Trump did his traditional south of the border, entree move. But he has CPI behind him. He has the price level. Forget about the rate of change. The price level's high. Oil's high. The CapEx boom is going. Like, if you're going to do it, now's the time to do it, right?
Yeah, I think so. And I think we should absolutely view this meeting as live. But what I was trying to think through over the weekend is whether I should do anything about it, because this is one of these situations where if you move, to be honest, the meeting is a crapshoot, right? So, you know, where's your expected value in positioning for a hike that's not priced? I think it's not great, and I suspect rates are moving in that direction for a relatively short period of time, right? So unless you think that a hike's going to do a huge amount of damage to your portfolio, my conclusion is I'm kind of going to sit on my hands on this.
Yeah, I mean, you could obviously do a spread between September and call it maybe December or the H7s, which a former favorite of mine, which I'm glad I no longer own. And
thank you.
Yeah, I was super happy when I moved out to the Z7s, and eventually I had to bend the knee on the Z7s. And then, you know, but I think we're back in business on the Z7s. We started buying them again a little bit. But you could do a spread, right? If that's your expectation, that like there's an outside chance that, I mean, I don't think he'd do 50, but like honestly, if he's going to hike, he should do 50. Like there's no point to do a 25 basis point hike. It serves no purpose. Like, you know, like if you're want to try and do the beating the chest, as you said, I'm a tough guy, just do it now. Like, and sets you up for better like time to be cutting. I don't know, like a sustained hike cycle.
No, that's not going to happen, right?
No.
And there's a risk that a 50 looks like Greenspan's 75 in November 1994. Just a little bit too much with hindsight.
Yeah, and let's pull this chart back up just real quick so you can see this. I mean, these are both the same chart. Just one has Rupert's little things and one has our brand and goes back a little farther. But if you look, you know, in that late 90s, you have the August of 98 episode with, you know, the Asia contagion of 97 finally coming through, and then the Russian default that then sent the relative value trader extraordinaires known as long-term capital management, like, and then the Fed had to bail them out. And so you got that 50 basis point cut, but then they went, you know, they did do about 200 more or 150 more from that point. So that's like the only precedent really we have. And you know, if you want to call it the modern era, you have that early 80s mini cycle. But I mean, like, look, right now, the one thing I put on my chart on the left, the 2-year is definitely diverging. And the 2-year usually is what you want to follow. If you're not a guy who has, you know, doesn't follow SOFRs, doesn't have a Bloomberg, blah, blah, blah. The easiest way to see what the market is, the actual guys who trade STIR and are looking at expectations of policy, the 2-year usually gives you the answer, more or less.
Hey, listen, there's a huge school of thought amongst traders that, you know, the Fed should be closed and that monetary policy should just be set by reference to the 2-year yield, right?
Which I subscribe to that, and I've tweeted about it. Like I fully subscribe to that theory. basically.
So, I mean, one of the things, the menu that I was going through in my head this weekend, and here we don't need to talk about sofas, but there are some interesting retail products. So the ETF TUA from Simplify Asset Management is basically a 5 times levered position in 2-year note futures, right? That's an interesting trade. I thought about it, but essentially figured that, you know, I probably wouldn't be prepared to put it on the kind of size that was going to make a huge amount of difference, right? And so my inclination is to just wait. If we do get a hike, I think you buy the dip in the dip in short end rates, right?
Yeah, I mean, even if it's just a trade, like the Warsh meeting, you knew he was going to come out hawkish and talk about he's going to do this and that. And that was a good sell-off. That was a good buy opportunity. And then you bounce back to where pre-Warsh was. Now, because oil had his like second move, which we'll talk about in a second. Yeah, and here's the hikes, you know, or the odds. The one on the right is the odds for this meeting, which you can see the yellow showing you just north of 30%. And the one on the left is from Bloomberg, and it shows you the odds of hike and implied rate and, you know, percentage. So you see basically 2 and a little bit hikes priced in by January. You know, I just would front run it, honestly. If you're really like, hey, this is what the market's thinking, and why dick around? I mean, like, honestly.
Well, if you were Warsh, you would front run it and take them both now. I don't think he's going to do that. I don't think he's.
I get it, but again, like, you know, we're talking about the death shot, so I'm just, why not? I mean, they did that in June of 2000. Like, just do a 50 basis point hike. You know, like, you can argue Powell should have never cut 150. Maybe he should have cut 50 to 75. You take half of it back. You gain some, you know, I don't know what you want to call it. Credibility. Yeah, exactly. As like you're coming in and you're not a pushover. And then, you know, you let it play out. But again, like we've talked about on the show numerous times, including last Sunday, private credit's SOFR funded. Private credit is not in a good spot, as we had private credit analysts on Lax from Unicus Research kind of lay out. We've talked about it. We know the AI thing is,
and you saw both of them
basically incrementally funded by that space. Go ahead.
And you saw some interesting resignations in private equity land after the close for late filing Friday.
Oh yeah, I sent that out to the chat.
The rats are leaving the sinking ship. Now, the other reason for not thinking that, the 50 is justifiable here is that financial conditions have really tightened a hell of a lot in recent weeks. You know, not just the rate picture, but you've got credit, you've got energy. You've got FX tightening things up.
Yeah, let's run through it. And then you have a nice summary chart at the end that if you stick around with us, you'll see Rupert put together a kind of the conglomerate chart. But like, let's go through it here. Back to the Four Horsemen, like it's March 2026 again. We figured we needed a break from AI. We've talked about AI enough. It's time to get back to macro this episode. So this is a funny chart because the landman chart has come back, and let's give a little golf clap to Rupert, the squirrel, for buying the dip there. He was a little early.
I was too early. I could have done it a lot better than that. That's for certain.
Well, that's why you sell research and you don't trade.
It's got my positioning in it. But listen, that's good. But the open today is less exciting, right?
Yeah, opens down minus 4 or 5 as we mentioned. But regardless, remember, my view is always oil and volatility are the price of real money. Oil going up tightens liquidity. It's never good for anything financial, essentially. So we can all argue, okay, on a inflation adjusted basis, 90 is not what it used to be. You know, and I get all that. 20, even just verse 22, to be fair. But it's, you know, it's had a pretty good move in the last month, right, Roop? Like we're talking about.
Yeah. No, it's a
28% is a bit of a ripper in a month for the, you know,
absolutely
number one traded commodity in the world, or I guess gold in that, and number 2. And this one is just, you know, to try and show the vol on the bottom. That's the 50 delta at the money vol, and you see it perking up, right? This is since COVID, yeah, we're kind of at the upper end. So where it goes, it'll probably get hit tomorrow. But there was some percolation of people getting a little nervous. We got Rupert's best friend, the doll hair. In this one, I'm using the BBDXY, or no, this like the BBDXY. Sorry, not the DXY, because I like to underplay the role of the euro, because a lot of people get sucked into the DXY and it's just so euro. And to go back to the start, Trichet, like that is not the world economy. That's the old world economy, right? And they still have they have too much influence for their economic position. Let's put it that way. And so, but look,
it's still a pretty big market, but the number is at 55-60% in the basket is wrong for the DXY.
Exactly. That's what I'm trying to say. I'm just trying to give, the U.S. trade weighted is probably better, but anyway, point is,
it's not tradable.
This is the dollar versus NASDAQ to S&P, which we like to think of as like tertiary, growth versus more equal weighted. The Kospi, which is the outer of the risk divided by the S&P, and then silver to gold. Basically we've seen this whole thing kind of roll over since, I don't know, mid-June, early June, late May, kind of those outer risk areas. And the dollar is just kind of staying steady. It's the DXY is even stronger. And so you got the oil strong, despite, what today, dollar strong. And then we have what's coming back into favor is the high yield credit spreads. And,
so coming back into favor,
into my favor.
In your favor, exactly. Now, I think, we haven't got this on here, but I think almost what's more interesting is what's going on in investment grade credit spreads, because that's really quite a significant widening. And I think it really, back to this theme of tightening of financial conditions, what's going on in investment grade credit almost amounts to a kind of form of quantitative tightening, with the competition in terms of supply that's coming, particularly from the hyperscaler credits, right? And I know you've got a chart in here for that. But
the only thing I point out on this chart is just that line that I don't know why Gemini made it 2 lines, but the line that is 2 lines is the CCC spread. So the junkiest of the junk, if you will, minus the top end of the high yield, the double Bs. And you're seeing that widen, and the average index of high yield is, it's rising. It's up 15, 20 bips, or whatever in the last little bit. But like still that divergence is like pretty wide, and these usually trade together. And then to Rupert's point, this is what's driving it, right? Like these are the guys issuing the debt. This is why, look at that orange line from SpaceX. That's a brand new CDS. We haven't seen CDS new issuance like this, like where there's new tradable CDS in a long time. Like I think it's like since the GFC. I didn't trade CDS actively during the oil boom, and it probably was within that localized spot. Like there was some of it, but we have Meta CDS came out last fall. We have SpaceX CDS, CoreWeave CDS. That was about September last year. Trading volumes are up, and more importantly, it's because spreads are up. Like whether it's because of the regulatory component of banks need to hedge their exposure, and they want to keep the, as our buddy Charlie, friend of the show, Charlie Peabody would say, is like capital markets business at banks is booming, like absolutely booming. But look at that, like Oracle, we talked, I guess it was right before we started the show, but Rupert and I talked, and like Oracle was 45 basis points IG and now is north of 200. That's just an enormous move, right? On 115 billion of notional.
I think it's important because these sound like sort of small numbers in percentage terms, but investment grade credit portfolio managers are not used to this kind of spread volatility or this kind of widening in their face. This does a lot to undermine risk appetite when things like that happen, and amongst the largest issuers in the market, right?
Yeah, and you know what's interesting is our buddy George Gammon called me, and he saw our show, and we were talking about how the thing that people get wrong with sovereign is they like to think supply is going to overwhelm the yield. Well, maybe at some point, but like truth is, because especially U.S. debt is like this ultimate underlying collateral of the financial system, but we're seeing the supply overwhelming the yield here. So that the people who argue supply affects yields, that's what's happening right now. Because I don't think that the hyperscalers, with the exception of CoreWeave, which is a total garbage fire, and then Oracle, which is a binary situation. Right now, Oracle's not a deal. Still, the data is very important. That business isn't going anywhere. Will their CapEx pay off? Is OpenAI, is there bet on OpenAI? There's questions. So, the market has responded, and they don't have the free cash flow. But the hyperscalers, it's they can turn it off.
Investment grade credit managers cannot afford to take binary risks, which is why that paper is
Agreed.
where it is. Right? They're not in the business of rolling the dice, right? And all I'm saying is that this move amongst the largest issuers in terms of spread is having a sort of a massive, broader felt impact on financial conditions, which gets me back to my initial point, which is that the market's done most of the tightening for Warsh. So maybe a mini hike this week, once and done for show. He takes it while he can. Right?
Let me get one caveat about this. Is it in that chart you'll show at the end, shows it credit is getting more play in the mental space of podcasts and research and worry than it is as a total of debt and stuff. But it's because it's the incremental funder of the dominant driver of risk assets, which is this CapEx boom, right? And the excitement and the growth potential and all that. And let's be clear, Google last week, negative free cash flow, first time since they're public. I've talked about that monitor, that website I created that has a countdown. We're now almost 50 days away from them all being negative. We're actually closer now because Google went a little more negative than we thought. And, it means that the private credit and the public credit market is super important to keep this train on the tracks, more or less. I think that's the way to think about it.
Absolutely. And we've got the rest of the hyperscalers reporting this week. And I'm just wondering if they take a look at what Google did last week and go, maybe we need to be a little less punchy. And I don't know what that does to stocks, right? If they show some kind of reticence towards the all-in approach to AIDC CapEx, is that a good thing or a bad thing for stocks right now?
I think that's actually a great point, Rupert, is that under the surface is where the game's being played right now. In vol, single stock vol versus index vol is at the 99.9 percentile or 99%, whatever. Long the Kospi and short, the average stock was unbelievable. And then in the last couple of months, it's on the other side, it's been unbelievable. So the action under the hood, and, we like to think of ourselves as kind of like market mechanics guys. You come to the body shop that is Betty and the Squirrel on Sundays, and we kind of diagnose the engine.
More plumbing and entrails than body shop.
Yeah.
Right?
But basically, I think that if you pay attention to what's going on underneath the hood, there's a lot going on. If you just say, hey, I'm looking at the S&P, basically stuck at 7,500 for a while now, right? I know we're at 3% off that short-term high, but I showed that chart earlier that showed, that NASDAQ to S&P, NASDAQ to Dow had an 8 or 9 day losing streak, one of the longest losing streaks it's had. And, I don't remember exactly how long it was, but it was a long time. So I think that as of now, the game's being played underneath the hood. The question is, does it broaden out, right?
And also the most popular factor, right, for the market over the last couple of years, momentum has just had a shocking time. I mean, I was listening to Kevin Muir's podcast while I was walking the dog this morning, and he clipped up the Goldman guys, sort of Tony P and others, talking about, I think it's the worst worst period of time for the momentum factor in 45 years, according to the Goldman quants. Yeah, that's done.
It's weird because it was either Thursday or Friday. I sent out to the chat like momentum was up, like despite the Nasdaq being down, and like we hadn't really seen that. Like, and so I don't know. Maybe it was short covering. You know, that's the thing. Like,
So
we never really know.
It was a Goldman pod from midweek, I think. But I mean, ultimately, you know, it's caused an awful lot of technical damage to faster money, right?
Yeah, let's move on.
Okay, what do we got here next? We've got
so this is our friend the sovereign rates, which we kind of talked about the short end driven by the policy makers. But you know, the gold has been offered since, you know, yours truly was telling you it was the top in January. We've had a really good correction. I think gold is interesting to start looking at on the long side. I think that Rupert and I have talked, and there might be one more washout type of move, and like, you know,
I think it sells off if there is a hike this week, just because it would be rude not to. At which point, I think it looks quite interesting. In fact, very interesting.
Look, maybe you could put bids at 3,300 to 3,500, you know, and just sit there. And like, if you get hit, you're just fishing, you know, maybe the fish won't hit, maybe it'll hit. But like, if you go back to that real quick, that chart.
Yeah.
If you can see, and you know, I think Rupert's going to show it next. We've had the flattener, the purple line, you know, basically happened since about the time gold, you know, it's the gold and the flattener basically look like the same chart. And we had the 5-year, which is kind of like the 5-year forward is kind of like one of the more pure market expectations of forward inflation that, you know, no one knows, but, and maybe it can be conflated with term premium. But then you have the 5-year rate. Look at the 5-year rate. I'm glad I got out of that train about halfway through. Like, that's just a
monster move for the belly of the curve. It really is.
Oh my god. It's a move. Like,
just quickly, just cycling through, finish off on rates. So this is the last 3 months move across the curve, right? With the solid diamonds being, you know, current position as of Friday, right? This is a huge move. And then if you look at it in terms of, you know, bull and bear flattening, right? The light blue is the bear flattening, which has been the obviously the dominant factor over the past week, but really the dominant factor over the last 3 months, with a little bit of bull flattening on the odd day. But
that is a lot of bear flattening. I agree. Like, bear flattening is not necessarily what you want to see if you're funding on the short end. Let me put it that way.
And what I do, I like this chart. This is what we promised at the beginning. This is U.S. financial conditions year to date, which is the dark blue line. But what this does, from my clever friends at Augur Infinity, is it decomposes the contribution to those financial conditions. And so, you know, since mid-April, really it's rates that's been the long rates that's been the key contributor. Then FX volatility has really started to creep in the last 6 weeks, and then really in the last 2 weeks, finally we got some contribution from sort of equity risk off to that overall picture. I just don't think that credit has moved. Credit's the one that really hasn't moved, aside from what we talked about in IG. And I think that's possibly the next shoe to drop.
Yeah, that's probably fair. And then we have, basically, just to continue with that, we have finally keep going.
No, wrong presentation.
Wrong
so
one.
There we go.
Oops.
There we go.
There you go.
Yeah, that's one you want.
So we're just going to talk about that FX fall real quick. You know, like, we're still kind of there. Like, we've seen a little bit of yen vol start to creep up, because truth is, the yen's kind of binary. You know, we talked about it with Kevin. Like, the trend is definitely weaker yen, and if they really just don't convince people they give a shit that, you know, we get to 175 or something, so there's going to be some bidding there, and there's going to be bidding from guys like Kevin or you know, I mean, a lot of macro guys getting their ass handed to them on the other side. But look at the rest of them: euro dollar, sterling dollar, and even like the Kospi, the won. Our friend Tom Roderick, who poor guy was trying to pitch us the won back in February, and anyway, I bet you he couldn't imagine the Kospi would do what it would do, and then the won.
I tell you what, I tell you that the pair that has my interest.
Guys, that's just so funny to me.
I tell you what, sticking with the yen. I mean, I've got two pairs that have my interest, and I am long the yen against both the euro and the Swissie now. And this is a trade that Kev pitched last week. The Swissie short Swissie yen, which I think is really interesting, and it kind of, you can extract yourself from the big dollar debate, right? Because I'm not sure which side of the camp I am right now on that front. My portfolio has a negative dollar bias, but I've got a pretty big euro hedge against it. But I do want to find other ways to play yen strength against other fiat.
Yeah, no, because we didn't get to that like on the show, but I was going to tell Kevin, if you're betting yen strength, you're really just making a rates bet on the U.S. Like when my SOFR start working is when dollar yen, will go the other way, basically. Like that, in my opinion, that's what the actual bet is there. The Swissie, I know that they don't want a stronger currency than they have. That's a fact from like very high up guys. And so I don't know how much you're going to make, but I think that you got a bounded like asymmetric to it. Like they're just not going to move much. Like they're going to try and not let the currency strengthen. The euro's tough because I hate the euro so much that, like
you hate it so much, frankly, you shouldn't trade it. Is what I'm
no,
say.
I actually I'll endorse euro yen because I think the euro's way over its skis, and the yen like has the potential as they laid out to strengthen. I don't see any scenario where the euro can strengthen. So I like that. I actually do like that. I like euro yen better than Swiss yen. Swiss yen you kind of know because
it's a technical point about hedge ratios, which Kev did actually talk about a little bit on the show. Anyway,
so let's just talk about equity volatility on the index level, kind of nothing burger. But below the surface, you have, we've shown this chart many times, NASDAQ vol, and I think we talked about this the last time I brought this chart up was when that green line was there. And that shows you kind of this, you line that up versus NASDAQ by S&P, line that up versus, basically Kospi S&P. You had those kind of roll over at the same time. And basically we're going to have a situation where I think under the hood dynamics are what matter. And then what I wanted to do real quick for people is I had a buddy ask me to send me my, there's a concept of a volatility curve can be like turned into an implied yield curve. So I have a spreadsheet, which, we'll give subscribers, like people who pay, I'll send them the spreadsheet if you want, but like you can put in there, if you have a Bloomberg, it actually automatics. But like the idea here, and I'll just leave it like this, is you can see why zero DTE is so popular. Because if you're a guy who's in the zero DT supplying business, look at those implied yield curves. Like, right? Yeah. Like, so just so people clear, the blue one is just an at the money single option, and the red one is a straddle, right? So you're doing both, and you're just trying to extract vol. Well, I don't know, Rupert. I mean, 130% annualized vol for a week. Like, you know, I know you're not a vol seller, but like that does look a lot better than selling vol for 2 years at 8 to 16% range, doesn't it?
What I would say is that, I've actually recently started adding vol positions, and one of the things that's really sort of struck me is just how, if you look at positioning in the VIX complex, large specs are about as short as they have been for a long while, right? And I know this is all dispersion trade related, and that's a big reason why I'm in the trade for an unwind of that. But stretch positioning in the VIX complex going into light liquidity in the summer with a war on, with an uncertain Fed meeting coming up in the next week, with all sorts of other shit that's
and the
going
double
wrong
levered
in the world.
ETFs that we talked about. And it's funny. I had a guy send me today, a partner of mine at Wall Street Beats, about margin debt, and it was like, okay, margin debt's high, but I'm like, you're thinking like, this is a guy who ran a huge fund in the 90s. Like that was like the incremental leverage driver. Well, now we have the options, and I just showed you why the explosion. I'm sure anyone who follows us has seen on Twitter or a brokerage of like the explosion of short-term options as a percentage of volume of the S&P. Well, look, the guys who are selling it are making huge yields, and they're very much not interested in things getting crazy. But if you think about it, then when you have those kind of yields and you have to apply leverage to get those yields, then that's why these vol events happen, because then they got to unwind it all at the same time. Exactly. And then you have the repo debt, and then so there's just the double levered ETF, and so it's just like there's lots of channels of leverage, basically.
Yeah, it's as Dredge would say, it's the brush on the forest floor, and there's just too much of it around for my comfort right now. Anyway,
yeah,
listen,
and especially at the end of the cycle, the title of the show is Death Shot, and if anybody's new here, go back and look, but I've been talking about AI ROI and AI CapEx, and we've been talking about like data, like we can see like the writing on the wall, and that's been the primary private sector driver, and the government's already at 6% of GDP, and now the Fed's talking about hiking, and oil's up. Like, I don't know, like tough. It's tough cooking to be a vol seller. You got a little bump here, like that maybe makes it a little more interesting, but oof.
Yeah. Listen, stay safe out there this week. Join us on the live show on Thursday. And please follow us on the Instagram to make Margot happy.
And make sure you come ask some questions. We haven't done one of those Ask Me Anythings in a while, so it'll be fun.
Okay. Well, that's it for this evening. Benny and the Squirrel.